Should all small merchants start accepting or start using orchestration? I think it comes down to how big is the pain, or how big is the pain that you anticipate to see as you continue to grow your business. And if that pain outpaces the cost of enabling an orchestration platform, definitely enable an orchestration platform. Something that is human, what we find ourselves doing is chasing the next shiny object. I think the most pragmatic and simple thing that any merchant or business out accepting payments can do is understanding your baseline metrics. I'd go back to those impact levels around revenue, cost, operating expenses or capital expenses, and then just strategic, like what's the strategic thing that you care about? And having a baseline picture, and then looking back and saying, based on the resources, budgets, capabilities that I have access to, what are those low-hanging fruits that I can address?
Today, my guest is Zubin Vandrevala, the Vice President of Gr4vy, one of the leading payment orchestration platform. In this episode, we talked about everything payment orchestration, what type of merchant benefit the most, where it is required or where it's maybe less required. Should small merchant, when they just start accepting payments, start with payment orchestration platforms? My favorite part of this episode where we simulated the conversation between customer and the vendor, when I brought all the objections and hesitation, and Zubin provided context and explained benefits of the payment orchestration platform. I hope you will enjoy this conversation as much as I did, and with this, please welcome Zubin Vandrevala. Hi Zubin, and thank you for joining our podcast today.
Thanks, Nikita. Pleasure to be here.
Tell me about why most of the merchants today prefer payment orchestration, or maybe even need payment orchestration to process payments efficiently.
I do want to acknowledge and thank you for giving me the opportunity to be on this forum. A little background about myself. I'm Zubin. I lead our global commercial team here at Gr4vy. I've been first business hire, been here for the last 4 years. Prior to Gr4vy, spent a little over 7 years working on various different capacities within Google's consumer payments organization. Prior to that, spent about 4 years working at Visa, as Visa was making the transition from 16-digit card numbers to digital tokens and everything that we know of Visa today. Started my career in financial services, working at a bank, worked at HSBC doing credit card origination, and then actually ironically have a mechanical engineering degree, spent the first couple of years working in the automotive industry, and somehow that translated into a career in payments. But I'll save that story for another time. To address your questions, I think if you go back to the thesis of why Gr4vy is created, it really comes from this notion that businesses around the world are creating payments teams. And it typically starts with, I want to start accepting payments. And if you look at the innovation that has happened over the last 10 to 15 years, you have companies like Stripe, Adyen, Braintree, others who've made it really, really simple to start accepting payments. 10 lines of code and you're off to the races. If I would draw a straight line, the growth we've seen in the e-com world over the last 10 or 15 years is directly attributed to the innovation around this space. Again, that's fantastic if I'm an entrepreneur, a small business looking to accept payments. But the second I become a large business, the complexity increases. I need to have redundancy, going international, I support local payment methods, I need to support local acquiring, I need to manage my risk. All of that complexity translates into APIs. And what started as 10 lines of code quickly becomes a spaghetti of APIs that ultimately forms on a payment engineering team to manage. That is the challenge that Gr4vy and other payment orchestration players are attempting to solve. How do you enable an infrastructure layer that helps you deploy, manage, customize, optimize, aka orchestrate your payments with ease? Hopefully that gives you a little background of why orchestration exists in the market today.
Can you share the story, your favorite case study or your favorite merchant when they were struggling without payment orchestration and the results they saw with the payment orchestration?
This one's dear to my heart because it's one of the early adopters of what Gr4vy technology is. They've eventually become an investor and they're all in on the Gr4vy strategy. When I think back to the originations of Gr4vy, one of the things that was really important to us was really talking to, and again, I don't want to take any credit for this. This was our founding members, John, Ali, and Cristiano, who essentially set out to create Gr4vy and had the vision around Gr4vy. From a technical perspective of essentially creating that infrastructure layer seems rather simple. The challenges were on really speaking to merchants and businesses and saying, hey, we created this platform. Would you adopt it? And they went and spoke to a large number of companies. I think the resounding answer was yes, from a technical perspective, we'd love for you to create a platform like this. But one, how do we ensure you do not become a single point of failure? But two, more importantly, how do you not add to the payment stacks? What we have created here at Gr4vy is a cloud native company. For every customer that comes onto our platform, we deploy a dedicated instance of Gr4vy that is configured for the capabilities, performance, redundancy, and performance requirements tailored to that customer. And so to come back to your question on my favorite use case, ensuring that we do not become an additional tax into the ecosystem, we ensured that the way that we price our business model is really to that infrastructure. So again, Nikita, coming back to your point about what is the best use case, very early on, Woolworths Group, for those of you not familiar, largest retail group out of Australia. 1 in every 5 transactions that happen in the market originate through some Woolworths property. 60 billion in revenue, 200 million transactions, so massive. Think Walmart of Australia. They had an internal payments team, really as a cost center, no different from any large platform out there. They made the strategic decision to spin out their payments team into a separate wholly owned entity called WPay. As they made that spinning out around the time Gr4vy was created, they realized that what they really required was to create an orchestration layer. They went through a typical build versus buy assessment. We did a ton of due diligence with them, and ultimately they adopted Gr4vy all in. And I think the value to them really came from the fact that not only do they have multiple sub-brands, think Woolworths Online, think Big W, think My Deal, think a whole bunch of these sub-brands that sort of sit under them, but more importantly, they were constantly doing M&A. So they were acquiring new companies, they were integrating new companies, divesting companies. So being able to decouple the front end from the back end, essentially what PSPs you connect to, was extremely important for them. They also happen to connect directly to the switch. So they happen to be one of the largest non-bank acquirers in the market, which also meant that they were able to do additional optimization in the back, which enabled this orchestration layer, decoupling the front end to the back end, made it rather easy for them. They're one of our top customers. They're an investor in Gr4vy. And I love that use case because it's not just a merchant use case, it's also a PSP use case, and it's sort of all in between. We're massive fans, they're massive fans, and we love that use case.
When I'm thinking about payment orchestration, it feels like that's for bigger merchants. So when the company just starting, they're just Googling how to accept payments, they finding like this, the payment service provider, they're signing the contract and they start working with this payment service provider. And then when they grow, they start feeling the pain of their growth, of how to process payments more efficiently, how to process internationally. These small merchants need to go through the pain of migration from a single provider to a multi-provider. And that's not always smooth and easy. And basically every merchant who is growing, going through this process. Is this what you're seeing, and how to avoid this transition? Would you recommend smaller merchants start with an orchestration platform?
That's a fantastic question. Our starting hypothesis was very much based on that. The larger you are, the more complex your business is. But the dimension I do want to add is complexity. It's not necessarily size, but complexity that defines whether you need orchestration or not. We've started to see that mid-sized merchants that are starting to see that complexity. That complexity typically comes from trying to expand internationally. I have a complexity in multiple sub-merchants that are sub-brands that I'm managing. I'm trying to manage a set of risk variables that make it complex. So the need to have multiple payment options. It's complexity and business complexity that defines when or if you need orchestration. You asked a fundamental question. Should all small merchants start accepting or start using orchestration? I think it comes down to how big is the pain, or how big is the pain that you anticipate to see as you continue to grow your business. And if that pain outpaces the cost of enabling an orchestration platform, definitely enable an orchestration platform. And I know in our prep, we talked about sort of this build versus buy. In many cases, the right thing to do might even be to build that in-house. But understanding and being really clear about what are those pain points that you anticipate to see, and then doing a true build versus buy analysis to say, hey, it is more cost effective for me to build it in-house versus use an external party, ultimately decides the direction you take.
When you talk about complexity, let's talk maybe a little bit more about profiles. And I'm sure on the Gr4vy side, you are like profiling prospects and your existing customers. What merchant profile do you feel benefit from the payment orchestration the most? Is it merchants who are processing high volume, or they're processing internationally, or they need payouts or their platforms?
We definitely see that. And, even as we're looking at sort of profiles of profiles, the segmentation of the market, we definitely see what we call sort of gravy for merchants, where it's a single merchant looking to expand globally, have multiple brands, a single, family of brands that is enabling various different consumer profiles, various different risk profiles. The need to manage that complexity is where orchestration fits in. The other couple of areas that we've been seeing a ton of adoption is, I would sort of call it almost on the aggregator platforms, where it's platforms, whether it's independent software vendors serving merchants and realizing that complexity starts happening with them. In many cases, we've seen some massive ISOs out there, massive PSPs out there that also have that same level of complexity and need orchestration. So while the conventional wisdom has been very much on the merchant side of the world, we're seeing some fantastic use cases that have enable more on the platform side of this. This is essentially platforms enabling their sub-merchants to take advantage of orchestration. The other interesting use case we're starting to see is operating companies that have different use cases within their own remit of operations. I have certain activities that I'm enabling with a card. That same level of card, I want somebody to be using the concession stands to buy tchotchkes or accessories that they might be buying. And so all enabling those use cases has sort of become another really interesting use case where we're starting to see the use of orchestration play. It's a wild west right now. As we've been talking to more customers, we're uncovering a lot more interesting use cases where orchestration is relevant.
You also mentioned very interesting topic, build versus buy. I believe in terms of the payment orchestration platforms, build almost necessarily means going through PCI certification and this whole process. Many payment orchestration platforms, several years ago, they called themselves like a third-party vault, right? And a vault is one of the biggest value, and that's the value proposition. And I believe it's still to that day. Do you think it's still the biggest value proposition when merchant consider build versus buy, or these days payment orchestration platforms, they evolve that it's like this value proposition blended through other features and capabilities that platforms deliver?
Great question. We get this all the time. And in fact, one of the signature strategies we've been deploying in any of our external conversations is bringing one of our customers who are using Gr4vy and facing them off almost on a panel with somebody who has built that in-house. It really comes down to your business, the incumbency, the legacy that you have on your platform, and where in that journey of orchestration you are stepping in. Even conventional wisdom says large organizations who have existing teams don't necessarily partner. We're seeing something very different. I think Woolworths is a great example. They had an incumbent team, but are still leveraging Gr4vy's platform to amplify and accelerate their growth and innovation. Coming back to the fundamental question about build versus buy, I'm going to take a strategic view of this in terms of the payment stack in totality. You talked about tokenization. If I kind of even up level this one a little bit further, where most of the orchestration players are playing right now is very much in that vaulting tokenization and the pay-in space. But if I zoom out, there's a ton of work and innovation that still needs to be happening around enrollment, onboarding, very relevant mostly in marketplace businesses, but still has some relevancy in a merchant use case or other business use cases. Then as you go further downstream, some of the treasury back office work around settlement, reconciliation, potentially payouts, all become very relevant. And you can keep going further down that chain of saying dispute management, chargeback management, and sort of sitting across all of this is sort of this data layer that sort of exists. I think the question really comes back to an organization saying, where in that journey do you have expertise? You very rightfully pointed out vaulting is an expensive and commoditized proposition, which really, unless you're someone like Google or a Netflix, there's no real value in bringing that in-house. Most organizations see that as a commoditized product. And either you use your PSP or a third-party vault as an enabler. To me, the bigger picture is for any organization to look at it and saying, where do I want to play in that bigger subset? Who are the players that play in that biggest subset? And what is the right combination or permutation of build versus buy that enables me in a cost-effective manner to maximize my outputs. So hopefully that gives you a sense. We do a lot of ROI analysis with our clients, etc. And happy to any of the listeners want to dive into that, happy to do that as well. But it really comes down to where in the business journey you are, what capabilities do you have, what are the outcomes that you're looking to get out of your business priorities.
Is there anything else you want to add on values?
The values, but it's a really interesting point, Nikita. And I think going back to the ROI, or what I describe it usually as ROYs, like, it's not always investments. It's like, why are we doing this? So your return on the whys. Really.
Right. I like it.
We've thought of this in the context of value of orchestration. It really comes down to 4 broader impact levers. There's the revenue side of it. And this is where probably people spend revenue. And I said, second one is cost, which is what gets probably the most attention. Of saying, hey, are you able to drive additional revenue for me, enable new payment options, drive more conversion? That's the revenue side of this. There's obviously the cost element of saying, hey, am I able to optimize my payment cost? Am I able to reduce cost routing? Am I able to enable network tokens to manage my risk? Am I able to sort of manage my fraud due to enabling? Those tend to be the primary focus of most business cases. But I think the other 2 that get less attention is really around something like operating costs. People don't always encounter the fact that to enable some of this stuff and to maintain it are large cost. You brought up the PCI certification, ongoing maintenance, managing all of that is a massive burden. And there's a massive cost to ensure compliance. Similarly, to manage the systems, to manage spikes in your business during Black Friday or whatever that may be, again, has a massive cost to you. So understanding not just your CapEx, but your OpEx as it relates to running your business, from people to resources to servers, is something that people don't always pay attention to, but I think is important to understand. Most CFOs and CTOs will probably be looking at that. The last one is more strategic in nature, right? You asked that question, should small businesses pick up orchestration? I think it comes down to what strategic leverage they're looking to get out of it. How do you future-proof your business? Understanding that and putting a value to that is really, like, I think the best way to think about the value of orchestration. It's revenue, it's cost, it's operating or capital expenses, and then essentially strategic value of future-proofing your business.
I collected some objections / hesitation from the merchants or from the market, from people who are considering payment orchestration platforms. So let's maybe do a little game and imagine that we are like in the procurement phase, and I'll bring these hesitations to you, and let's quickly go one by one.
Jump in. I'm excited. Yeah, right. Rapid fire.
So the first one is that I think the value proposition from some orchestration platforms that you're going with us, you're going to multi-processor orchestration, you'll be able to test smartly, but contracts are still required, that it's still on the merchant to sign new contract with all of these providers, and also to manage all the operational stuff, not only to negotiate pricing, to negotiate like all the services, do reporting, reconciliation, other operational processes to support this relationship. And this, I believe, or like, maybe like there is opinion on the market that it's kind of like slow the adoption for payment orchestration platforms. What do you think about it?
Love that question. We get that all the time. If I go back to where the market has been, that's really what the proposition of a gateway was. I have multiple acquirers that I want to enable. How do I do that in a single contract? And I kind of abstract the complexity of having to integrate to multiple acquirers. I mean, if you look at the origination of what CyberSource originally was, or has been for the majority of its time, or even any other gateway that sort of sits in front of multiple acquirers, sort of has that same value proposition. That's not the value proposition that we're going after. And in fact, if the proposition is around enabling at an acquirer level and having a single contract, not just on the card side, we see tons of really good success. You have the pre-pros of the world, the D-locals of the world, the e-banks of the world that are doing a fantastic job of consolidating that out. The insight and the problems that we're looking to address is somebody who says, I want to control that relationship, but I don't have the tech capabilities or the agility to manage that from a technical layer. That's the problem that we're looking to address. We definitely come across partners and customers who say this complexity adds in, but the problems that we think our technology and our platform can address is more technical in nature. not necessarily the contracting aspect. As we continue to evolve, there's a lot of efficiencies we can drive around onboarding. We're not there yet. If I look at the evolution of orchestration, I do see more on the operational side of things. We definitely can expect to see optimization happen.
Thank you. The number 2 I have is that enabling orchestration layer, and you mentioned this, can introduce an additional point of failure. For example, if I manage a couple integrations myself, even without PCI certification, I'm just like can switch the widget from one PSP to another, right? And I'll be using another payment service provider. It's not that elegant, and data will be stored in different places, but I will have a redundant layer to accept payments. With the orchestration layer, I have like really single instance, and if this orchestration layer is down, like all my integrations are down. Also, after Black Friday, Stripe or Adyen reported their 99 point, and there were so many nines after this. There is an opinion on the market that sometimes payment service providers are down, but it feels like this year's the top or like the premium payment service providers, they're quite stable. What do you think about this?
I love it. Let me talk about the second point before addressing the first, because I think it's an important distinction. And compared to the point of what is the value proposition of orchestration? If the pain you're trying to address is addressed by Stripe and Adyen, we would not argue that you should enable an orchestration platform. The reality of what we're seeing, and actually we work really closely with both Stripe and Adyen, a large number of customers that use them also enable a host of other PSPs for a variety of reasons. It's not just redundancy, but reaching a particular market that Stripe or Adyen may not be in, providing payment options that they don't provide, or enabling certain risk profiles that Stripe or Adyen may not choose to go after. If your needs are being solved by a Stripe or an Adyen, or Braintree, or Checkout, or Chase, you should lean in on them. And that's going to give you the maximum benefit. The complexity comes in, the points that I made earlier, where the value of orchestration comes in. To address your question around points of failure, the best way to think about it is realizing where those points of failure happen. I think at the most fundamental level, orchestration solves for if a PSP is down, how do you create a failover? We've seen on our own data, a very large merchant enabled a dual PSP strategy. They chose to go with a primary PSP that gave them the lowest cost, recognizing that they may not have the highest approval, but then they also enabled a secondary PSP for any failovers. They saw almost a 3% lift in auth rates by enabling that dual strategy. So getting the lowest cost, but then backing that up with a higher performing PSP that may be more expensive, essentially enabling 3% uplift in auth rates. And for anyone who's watching this video, look at your own business, work with 3% uplift of auth rates. That's point number one. The second point is what happens if one of the instances that Gr4vy is hosted on goes down? We've seen a bunch of our merchants as we came through Black Friday and Cyber Monday, a bunch of our merchants enabled backup instances, sometimes in the same zone, sometimes in multiple different zones, to create that backstop. About 2 years ago, where there was a massive heat wave out of, I think, the UK or European data centers for Google, and Google actually went down for a short period of time. We were able to very quickly move a lot of our traffic to a completely different region and bring those back up in a very short period of time. So again, that flexibility and fluidity of cloud enabled us to do that. I think the third point of failure that's a claims is like, hey, what happens if there's a workload increase in Gr4vy's instance or bad code that is introduced? I'll give an example of one of our top merchants. They've enabled multiple instances where we deploy, it's a production instance that they have, but we deploy all our code into a particular instance. We value and feel our code is really strong. But again, it's trust and verify. They wanted to be able to verify that independently as well. They do testing in a production instance on our code, and a week later, they promote it into what they call their production environment. The architecture, the modular architecture, the single instance architecture that we've enabled gives the control back to the merchant to say, hey, there are multiple points of failure. How do I minimize that based on the risk, cost, complexity, and intensity of my business to support the least or minimize those risk levels, the single point of failures to the minimum?
Right. So what I'm hearing is not just black and white, right?
Absolutely. And I think, yes, there is a general buzzword in the market. Oh, orchestration adds this point of failure and managing it in-house adds a point of failure, right? I take the day off and I'm the only person on the ops team. Something goes wrong, my system is down. If you have a massive ops team, you're able to manage that complexity and a sophisticated sort of infrastructure team. Absolutely, you might be able to manage that in-house as well.
With payment orchestration, data belongs to you, right? So you're not selling your data to PSP and you're not tokenizing with PSP, but when you're tokenizing with an orchestration platform, you're still in control of your data. However, with payment orchestration platform, you're still getting back like proprietary tokens, right? So with Gr4vy, I would assume that as a merchant, I'll get back Gr4vy tokens and I can use them only with Gr4vy. I maybe can, through Gr4vy, route this transaction somewhere else, but I don't see the biggest difference with PSP tokens or with Gr4vy tokens. Is there a completely different approach from the merchant perspective based on the data that I own?
I love that question because, again, there's layers to that. And let's unpack those layers, right? I worked 7 years at Google. Google has hundreds of millions of cards on file. In their scenario, it absolutely makes sense to tokenize and manage that complexity and ownership in-house. Majority of merchants do not have the resources, cost, or inclination to manage that complexity in-house. That is a massive burden and a commoditized product offering. The reality for the merchant in that context is there are a couple of options. You could either work with your PSP, enable PSP tokens. The challenge with that works really, really well if you're sort of enabled in the context of that PSP. What happens when you're enabling multiple PSPs? The second point is, let's say I go with a third-party vault provider. Absolutely, you can enable that in the context of that vault provider. But again, there's certain limitations to the point that you made, their proprietary tokens, etc. I think the approach we've taken, it's the most holistic approach. And it's not only us, there's a bunch of other players doing this as well. We give you the option of going back with a Gr4vy token, but we also give you the option of receiving PSP tokens back to you. It's the business in the context of what you're trying to enable. Most merchants say, I want a single token to charge that transaction and then manage that complexity in your no-code dashboard. We've also seen instances where if you are fully PCI compliant, we can give you back the full PAN. There's no hesitation on our point, but it really means you need to be PCI compliant. The solution in between that we see tons of merchants taking advantage of is network tokens. The way we've implemented network tokens is we don't create the network tokens with a token requester ID or TRID that is Gr4vy. We generate it with the merchant owning that TRID. So the merchant has full control and portability and the ability to be cross PSP or PSP agnostic with those network tokens. So I think we definitely are leaning on the favor of merchants having better control over that data. And again, I don't want to say we as in Gr4vy. I think the industry is moving in that direction. Network tokens are enabling you to be much more flexible. My only word of caution to any merchant out there is when you think about generating network tokens, think about it in the context of, are you truly in control of those network tokens or are they locked into a specific third party, whether it's your PSP or the third parties? Who is ultimately the owner of those trades?
Yeah, with the network tokens, it's definitely a challenge to understand who is the owner. The next one is more about cost optimization. You mentioned multiple times that payment orchestration platform shines for merchants with high complexity. But also I heard other value propositions that with payment orchestrations based on smart routing, optimizations, A/B tests, merchants can reduce the cost of processing payments, like reduce fees and also increase authorization rate. There is another opinion on the market that this can be achieved only on a very kind of like high volume merchants, right? Only if you process significant volume. That's where these optimizations make sense. Before going into that optimization, merchants can talk to their current payment service provider and try to resolve the problem with them. It will be way cheaper than switching integrations and going through the orchestration platform. What do you think about that? Do you see successful cases where merchants can achieve really significant results of optimizing costs and authorization rate, even if they are not very big merchants?
I think because, again, we're talking in abstract, and the analogy I would use is the cost of minimizing the pain greater than the cost of enabling orchestration? That's the calculus most people need to make based on their business need. And if that pain is sort of greater, or the cost of managing that pain is greater than the cost of optimization, then absolutely that sort of calculus comes in. And so there's no amount of volume or complexity that comes in. I think examples where we've seen that is, merchants that are sort of high risk, maybe low transactions, but high risk. They get approved for small TPV or transaction payment volumes with specific providers. There, the optimization becomes real. Like, how do you manage against that? We've also seen examples where merchants are saying, hey, I want to just go after the cheapest PSP for my primary business because it enables me to keep my costs really, really down. But I also know that when anyone who's been in payments is a three-legged stool. It's not always about the lowest cost. It's about the lowest cost authorization rates, maximizing authorizations, and doing all of that while minimizing your cost. We've seen examples where people are saying, hey, I want to just go after the lowest cost, but that does come at an expense of authorization rates. So finding a strategy that allows you to balance that stool based on your business needs. If your pain or the cost of managing that pain doesn't outweigh the cost of enabling payment orchestration, then payment orchestration is the wrong choice for you. We've seen many examples where merchants, come with the hypothesis that, hey, I need to use orchestration. But we quickly realize with discovery questions that what they really need is to renegotiate with their PSP. We'll push them in that direction. And we're happy to give advice and guidance and help the industry move forward in this regard.
I love it. I really like your approach that merchant needs to understand first why they're doing this and then start considering and not just go after the shining object or the buzzword in the industry.
And by the way, orchestration is a buzzword.
Okay, let's go to the next one. It's one of my favorite, maybe because I'm more like a tech guy. I also heard some opinion on the market that basically outsourcing your API integrations, you're really relying on vendor, right, or on a partner. And these integrations can be really critical for your business. But when partner manages them, basically you're depending on the partner to support and maintain them. To give a specific example, if payment orchestration manages integration with one PSP, but your business needs to support 3D Secure on this integration. So you need to push your vendor to prioritize it on their roadmap, and you don't have control over this. You're kind of like in this vendor jail, and your business growth depends on how responsive your vendor is. 3DS is one example, right? There could be other examples, like I want to support this payment method on this payment provider, or these types of questions and limitations. Do you see this happening? Do you think it's one of the merchant pains, or it's more like a myth?
No, I think there's a reality to this. Like, if I gotta take a massive step back, when we were starting Gr4vy, one of the things that was very fundamental to us was we recognized that we could just go and connect to a whole host of payment connectors, do those integrations, and I would say like have a laundry list of payment integrations that we support on our website. We chose not to go down that path and took a more conservative approach to say, let's work with our clients to understand what payment service providers they want to integrate with, and then work with them to do those integrations. The happy parts are easy. The complexity, 80% of the complexity comes from the unhappy parts. So the point you're talking about is specific business have specific requirements. Hey, I'm sending certain indicators to my PSP, which are out of band from a typical happy path. Or I need to manage certain complexities in terms of use cases, in terms of how I authorize, settle, capture those transactions. All of those complexities, creating something in a vacuum or looking at purely the happy parts would mean that we're setting ourselves up for failure. To ensure that we're setting ourselves up for success, we wanted to work with the largest merchants in the world in solving their pains, and recognizing that once we start solving their pains, 50, 60, 70, 80% of those similar pains are being felt by other merchants in their category. So that's the approach we've taken. And what that's enabling us to do is that any connection on the Gr4vy page, we have actual live traffic flowing through it. To ensure those connections are up to date, we create partnership agreements. And those have been hard. Hopefully, I'm not sharing anything confidential. We just signed a partnership agreement with WorldPay yesterday. We've been working with them for the last 4 years. But we've been pushing to say, we just don't want to be a connection onto your platform. We actually do want to have a partnership that legitimizes our role in the ecosystem, but also then goes one step further and saying, like, how do we ensure that when things go wrong, we're able to have a point of contact that we can reach out to? When we're looking at those unhappy parts, how do we work with them to enable that? And then when things change on their side, as they update their platform, how do we get informed versus finding out because something broke as those changes happen? So I think looking at it not just from a technical perspective, but from a collaboration has been extremely critical in ensuring that we're building connections, which we're pushing to have live traffic in partnerships with. It's probably the recipe for success. So hopefully that addresses some of the concerns that exist in the market. But the meta point about connections ultimately getting updated, that's just the reality. Whether it's Gr4vy building them or another orchestration, or you as a merchant building those on your own, that pain will exist irrespective.
The pain of supporting all these integrations is definitely...
And maintaining and managing, I think that's the complexity, right? It's not just a happy path integrations.
Underestimated, I think, in the industry, how to support all of this.
Absolutely. And by the way, it's a commoditized product, right? Like if you're selling services out there, you then have a payments team that's managing these integrations and the complexity and the compliance. That's not your core business, right? And the reality is every merchant out there is building that same product over and over again, where there's no real differentiation of value that comes with that.
Let's quickly talk about the next one. Not sure if it's like core to your business, but the challenge what I also see with payment orchestration platform could be that it creates the challenge for marketplaces and platforms a little bit. And what I mean by that is that if the merchant operates in one PSP environment, they can process like pay in to pay out in one in one chain, and they're not touching the funds between the buyer and the seller, and they can send it from the buyer to the seller, right? If they're introducing payment orchestration platform in the middle, they need to onboard sellers in all these payment service providers, right? Or they'll be taking the funds themselves, which can expose them to risk and change the whole funds model. Do you see this problem solved somehow, or is it just not the right merchants for the payment orchestration platforms?
Fantastic question. And we spent a lot of time thinking about that internally. Nikita, if we're going to take a step back and look at the landscape of a marketplace business, the ability to pay and pay out is not a technical challenge. It's more fundamentally a KYC, KYB challenge. It's a compliance challenge. It's how do you know who's receiving those funds is the same entity as we are paying those funds? How do you ensure that you don't become the center of money laundering? Different merchants, different businesses, different marketplaces have different risk appetites. Enabling that is very much a business risk that entity is willing to take on. At this stage, I don't know of any orchestration player that is wanting to get into that compliance place just yet. I think from going back to the original thesis of Gr4vy, where orchestration plays, is really at that infrastructure layer. Today, we are supporting a bunch of marketplaces in terms of enabling payouts, pay-ins, the complexity around that, even settlements, data, etc. But when it comes fundamentally to that point of like, can I create an escrow account, or can I do KYC, KYB? Can I simplify that onboarding? Can I do some level of risk management? That's sort of outside the scope of at least where the orchestration industry right now is. Again, I don't want to say never. I think there's tons of innovation that's still required, but it's a more fundamental innovation around compliance, KYC, KYB than any sort of technical challenge.
Yeah, definitely. I agree with you. It feels quite straightforward, but how the funds are moving there, right?
Exactly. And it comes down to compliance, right? How do you not become the center of a money laundering racket? I think it's fundamentally a compliance. How do you manage that risk? I would argue there's a right for innovation out there. AI seems to be the buzzword. Is there something AI can do to enable innovation around sort of knowing your customer and being able to manage that risk? But again, different company, different space, but tons of innovation potentially in that space.
My last objection, what I wanted to talk about it, and actually you already mentioned how you're managing it, but I would be curious about if you have additional thoughts on that. Merchants who operate with a single payment service provider, they know basically whom to ask. And if they have an issue with the payments, it's can be somewhere in the middle, like in the integration, or on the payment service provider side, they have a single window approach, and they have kind of like understanding how quickly they'll get the information back. With an orchestration layer and with somewhere in between, it kind of like creates this complexity. So if merchant has the declined payment, they're asking their like orchestration provider can point the finger like, no, that's not us. We are sending how we were sending it for the last 10 years. It's something changed on the payment service provider. Payment service provider can come like, no, you're supplying us the wrong data and not sending required parameters. And for merchants, it's becoming like a very hard to resolve. And they need to like establish teams with like 3-party to investigate these issues, right? And to resolve these issues. In my experience, it was a little bit of pain to resolve. How Gr4vy solves this, or what do you think is the ideal way to solve this issue?
It's not just all the components that sit, but I think it's data and insights that sits across all of these components that'll be key to success. And Gr4vy, the way we've been looking at it is saying, how do we expose all the information that we're receiving from our PSPs, all the information as it relates to performance in a simple, easy, digestible, like you don't need to be an engineer to sort of access that information and then have control over it. I think we're early in that journey. Most of the industry is early in that journey. There's some people who've done phenomenal. In fact, I was on a panel with Anand from Optimized Payments, who's done a phenomenal job of building an entire business around analytics insight. And you're going to see a spectrum of that, right? How do you provide more information, more transparency in a way that someone as a layman can look at it and go like, oh yeah, I can see that happening. That's the end state that I think the industry is moving to, rather than sort of playing this blame game. Things are going to fail. Errors are going to happen. There's complexity around the way payments happens, especially when multiple parties are involved and you're managing more complexity into your system. But to be able to push that back in a way that's easily digestible and actionable, not just, hey, can I get an alert? Can I have a failover? If something goes wrong, something breaks, there's a failover. If something declines, I understand what those error codes are. If they're retriable error codes, I'm able to retry on those almost instantaneously, or automagically those already happen with the platform. That's the kind of level of not just insights, but actionable capabilities or functionality to then allow you to move that forward. In a traditional environment, things were breaking anyway, but the lack of insight meant that there'd be months before when you'd be leaving money on the table where you need to do an analysis, present that to your senior leadership. You get budget for it. There would be a waterfall roadmap to implement that. 6 months later, you implement it, only to realize there are 3 other things that are broken that also need fixing. That's the problem that we're trying to shift in the industry. And it comes with data and insights.
I love it. Make it more like self-service, right? Instead of trying to communicate. That was the last one from my list. Look, we survived this.
I love it.
I appreciate your insights. Let's switch gears a little bit and talk about industry in general. I have a couple more questions on that. Some of vendors in the payment orchestration space, they're claiming that now we're switching to more like new era in payments, to the open world of payments, where merchants having more control and payment service providers become more open. Do you see this happening? Do you agree with the statement that something fundamentally is changing right now?
A simple answer is yes. And I think that's the trend that drove the creation of Gr4vy. That's where we've seen primary levels of growth. There's a cyclicality to this, right? We see that with other industries where it's like unbundling, bundling, unbundling. We seem to be in that unbundling stage right now in terms of an industry. And it really comes from this thesis that merchants want not just control, but be able to pick and choose the best providers. And by the way, like Stripe is fantastic in a bunch of things, but when it comes to risk management, they may not be the ideal provider. They may be a better provider based on your business risk. If you want to go into a specific market, there may be specific requirements that Stripe may not be able to address. You can get some of the largest merchants and platforms out there. They may be running primary traffic through one particular provider, but on average, they are connecting to 3 to 5 providers. We are living in an age where there is this big unbundling happening. You see that not just in payments, you see that in broader commerce, with composable commerce and a bunch of other stuff that's happening in that. You see that more on the technology side of things. But coming back to payments, I do believe that unbundling is happening. Being able to connect, orchestrate, and manage that complexity is becoming more prevalent in the industry.
What do you think in general is the biggest problem or blocker in the payments industry right now that limits our improvements and limits us from having more secure, faster, and cheaper payments?
Nikita, that's a fantastic question. So if you look at the evolution of payments, like if you kind of go back sort of 20 odd years, payments was largely a person to person. Like you showed up at a store, you swiped a card. There was some complexity around sort of swiping that card, getting a signature. There was risk management. As the world has moved e-commerce, what it's also enabled is this opened up markets to enable more commerce to happen. But I think that also means that there's more users that have access to this, right? So if I'm selling a product out of India, especially if it's a digital product, the ability to consume that sees no bounds. You can have somebody coming in from Australia, somebody from Europe, somebody from US, being able to manage not just that complexity of providing it, but providing payment options that meet the needs of those customers, being able to manage the risk has translated into a level of complexity. The biggest pain that the payment industry is seeing is that this growth has translated into a level of complexity that we as an industry haven't necessarily updated our practices to support. It's great to see new payment options out there, but then how do you implement those payment options? How do you manage the risk around that? How do you do that in a cost-effective manner while continuing to run your core business? That's, to me, is the biggest pain, or the complexity and the opportunity that exists in the market for players like Gr4vy and others that are addressing that pain.
What do you think it's already available to merchants, but maybe merchants are doing it wrong? Or what's the most practical but simple advice you can give to most of the merchants, and it will be like the biggest bet for their buck?
Yeah, I think that's a great question. And something that is human, what we find ourselves doing is chasing the next shiny object. Suddenly something comes out, creating a kind of buzz, whether it's the new buy now, pay later option, or the pay by bank option, or some new technology. And everyone's like, I want that. You burn up your roadmap trying to implement something with very little impact. I think the most pragmatic and simple thing that any merchant or business out accepting payments can do is understanding your baseline metrics. I'd go back to those impact levels around revenue, cost, operating expenses or capital expenses, and then just strategic, like what's the strategic things that you care about, and having a baseline picture, and then looking back and saying, based on the resources, budgets, capabilities that I have access to, what are those low-hanging fruits that I can address? Some of it would be addressed with orchestration. Some of it might be renegotiating with your PSP. Some of it might be making small changes on your website as it relates to UI, UX that could translate that. To me, it's like, go back to the basics, go back to first principles, have a solid base side of what's going to run your business, and then really quickly identify what are those low-hanging fruits that I can enable. Orchestration isn't a silver bullet answer. Changing your PSP isn't a single the silver bullet answer to your strategy. Or implementing pay by bank is not going to bring your acceptance cost down because consumers may not be adopting it. So again, having that understanding of baseline, being able to understand what those low-hanging fruits are, is ultimately going to translate into the biggest ROIs in your business. Yeah.
Thank you so much. It's been absolutely a pleasure. I hope our listeners will enjoy this conversation as much as I did. And thank you for joining this podcast.
Nikita, I cannot thank you enough. We talk a lot with a lot of people on a one-to-one basis. The opportunity through you to reach a broader audience is invaluable to us. So thank you for the opportunity and really enjoyed this conversation.